Hi, it's Ryan from the Mandem Fund. Now, the IFS Student Investor Challenge begins in 2 days' time from now, the 23rd of October. And first of all, there's a few things we need to go through to anybody who's starting out in the competition and hasn't taken part in the practice round, or people who are confused on what you need to do as part of this competition. First of all, I'm going to begin, before I talk about what it consists of, due diligence. That's one phrase you need to get inside your head when going into investment. Now, due diligence is another word, a fancy investment term that many in the financial circle use to describe research. Now, this research is not reading what the company's name is, looking at the chart, not using any indicators or anything, and just saying, this looks fancy, I'm going to buy it. Do not do that. That will only one day, when one company that you say punt into, or just think is going to rise, crashes, then you've lost the majority of your portfolio. That is something that I completely discourage anybody to do. Now, due diligence in itself, in terms of this competition and in terms of normal investments, means analyzing the company. And you need to know, first of all, what the company does, how the sector overall is doing. And I might as well give an example. Let's look at a larger company such as Provident Financial and analyze previous performance. Provident Financial has fallen, I think, 80% from its highs of £32. Now, it did make lows at 450 odd pence because, first of all, the CEO, his name was Peter Crook, I think, he left the company. The company was having huge problems with their home credit lending business. And a quick insight into this, if I could summarize, they had a few defaults which they had to make in a lot of their client accounts. And when they made a lot of money from the home credit business and you have to write off debt, a lot of bad debt that you cannot retrieve, you lose a lot of assets that you once had. So that means Providence Financial had a very bad action on their share price. A lot of shorters were in the stock as well before this crash occurred, and the short position increased as the fall had happened. Now, this share in particular is used to making a large profit of hundreds of millions each year, and they released a forecast saying they're expected to make a loss of 60 to 100 million. Now, that was very scary, especially for a company that's not only unethical, but makes money from being unethical. And one would refer to it as easy money, because you lend somebody money at high interest rates, extremely high APRs, and just get the money back from them weekly. That is a very profitable business, yet unethical. But whether unethical affects your investment perspective, that's a discussion for another time. Now, with due diligence, you have to also know the risks of buying stock. There is never a 100% certain return on a stock, and you will always lose at least once, that's for sure. All the top investors have investment successes of 60 to 80%, maybe topping 85%. The reason that is that if you do 10 investments, say 6 of your investments are profitable and 4 are not profitable, you need to make sure that the magnitude of those 6 investments are much more profitable than the magnitude of the 4 investments that lost you. Because if you lose more than you gain on 4 than winning 6 in this case, that's not good at all. And if you buy something without researching it, you could definitely say that that's gambling. So please do not buy without researching. The website has many tools as well. If you click onto a stock from the company's list, you'll be able to see a few things like market cap, which is the current value of the company at the day. You'll also be able to see a few analyst forecasts. If you like to look at analyst forecasts, you can also look at the performance compared to the FTSE 100. That's something that helps a few people at looking at strength and maybe where the magnitude of the rise is when the FTSE 100 is doing well, and where the magnitude of one that correlates with the FTSE 100 when the FTSE 100 is doing badly. But then again, the FTSE 100 is an index which makes up the average price of all of the top 100 stocks in the UK. So ITV, that includes Sainsbury's, that includes Tesco, that includes many others. When these companies all in general do badly, or the most of them, this happens, the weighted movement is towards the downside, you get a drop in the FTSE 100. And if the movement of these equities or financial instruments or securities are moving upwards and the weighted movement is upwards, then you see a rise in the FTSE. But some stocks are kind of a magnitude. If you see 0.5% of the FTSE rising, you could see a magnitude rise of these ones that correlate with the FTSE. Some also do not correlate with the FTSE, but they differ on certain occasions. There's no 100% correlation between a stock and the FTSE, nor the FTSE and a stock, because it's all stocks in general. Now, we have 100 stocks in the competition, or shares, depends what you'd like to call them. Those are FTSE, and then we have another 50 shares that are small cap. These are higher risk, high reward companies. Here's an example, Ferrex Expo. They are one that I think is in Ukraine. I think it's in Ukraine. And they are in the iron ore industry. Same with Evraz and a few others. These ones are strong when the price of iron ore is strong and weak when the price of iron ore is weak, purely because they operate mostly in the prices of iron ore. And a few other commodities, they're not diversified metals, but they're iron ore weighted metal producers, I think, and exporters. Now in this competition, it's definitely quite competitive. So if you just guess an investment, there's no way of doing what you'd see as well. But the main aim of it is doing as good as you can and proving to yourself that you're learning investment, because the idea of investment is a very vital tool for anybody. And the financial system, one could argue, should be implemented into the educational system. But there's no 100% being right strategy, because you can lose money one day dependent on the market's overall performance or independent from the market's performance. It's more dependent on your strategy. Now, strategies change always. If you had a strategy last year and you took part, I recommend altering it. Now, we recovered from the practice round last year when we took part in the competition over at the Mandem Fund. We had one certain strategy. We'd altered our strategy this year for the practice round to see how it had gone against market performance, especially suited towards current market conditions. We're in a bull market right now, if many would notice. That made us end up in first place. Now, we may need to also alter our strategy as we go along in the competition, because company movement changes, company strength change, and this is every single company that is different. You cannot stick to one share, because when you stick to one share, and from experience I can tell you, at our team, we'd continuously lost on that share to the point that we had to personally bar ourselves and say, if we buy this, we should sell everything else and take a 1,000 fee, right? Because we need to get ourselves out of the habit of being attached. Do not get attached to one company, you know. You need to diversify yourself. And when you diversify yourself, you can get the most returns from a given period. Now, this competition will last 3 months, and I wish the best of luck to anybody participating and the other teams that we also have from our school. And I also wish the best of luck to the league table, as it always varies. One bit of advice I should also show, when you're in a team of 4, in this case, you should split duties. 2 people on the active and 2 people on the strategic. That's what I'd recommend. It's slightly more effective, and also you can get different perspectives. That's what we're doing over at the Mandem Fund. So I wish you all the best of luck, and here's to another year of SIC 2018. All the best, everyone.